Welcome! In this video, we'll break down how some investors legally pay zero federal income tax on long-term capital gains by strategically using the 0% bracket. We'll connect the dots between the 0% LTCG bracket, the standard deduction, and a technique called tax gain harvesting. By the end, you'll understand how to lock in tax-free gains, reset your cost basis, and plan your year so you don't leave money on the table. Let's begin, and then we'll walk through an agenda to frame the journey. Here's the plan. First, we'll define the 0% long-term capital gains bracket and how it pairs with your standard deduction. Next, we'll clarify the difference between gains and withdrawals because that distinction drives how much you can actually pull out tax-free. Then, we'll dive into tax gain harvesting, selling and repurchasing long-term positions to lock in gains and reset basis. After that, we'll cover timing and annual planning, then finish with pro tips, pitfalls, and a couple of quick quizzes to test your understanding. Before we dive deeper, a quick disclaimer. This video is for educational purposes only and is not tax, legal, or investment advice. Everyone's situation is unique, and tax rules and thresholds change over time. Please verify current IRS numbers and consult a qualified tax professional before implementing any strategy. Now, with expectations set, let's move into how the 0% LTCG bracket actually works. Let's unpack the mechanism. Long-term capital gains on assets held more than 1 year can fall into a 0% federal rate when your overall taxable income is modest. The practical trick is stacking your standard deduction with the 0% LTCG bracket limit. For example, single filers with little or no other ordinary income may be able to realize over $60,000 in long-term gains tax-free in current years. Married filing jointly typically sees larger thresholds. The essential point is that only the profit above your cost basis counts toward this limit. The total cash you withdraw from selling an asset is not the same as the taxable gain. With that key idea in mind, let's visualize how the stacking process flows end to end. This flowchart starts by establishing your ordinary income, things like wages, interest, and non-qualified dividends. If ordinary income exceeds your standard deduction, it begins to fill your lower brackets first, which reduces how much 0% LTCG space remains. If ordinary income is below your standard deduction, you have some remaining deduction to absorb income before any capital gains are considered. Next, you calculate the remaining 0% LTCG room, then identify long-term lots that are appreciated. If none exist, you stop. If they do exist, you plan sales so that the gains, not the withdrawals, fit neatly into your remaining 0% space. After executing the sales, you can typically repurchase the same asset immediately because wash sale rules apply to losses, not gains. That immediate repurchase resets your cost basis to the current market price, reducing future taxable gains. Finally, you carefully track documentation and confirm everything before the hard deadline of December 31st. Now that we've seen the flow, let's clarify the difference between gains and withdrawals with a concrete example. Consider this simple example. You sell shares for $60,000 that you originally purchased for $30,000. The taxable long-term gain is $30,000. The difference between sale proceeds and your cost basis, not the full $60,000. This means the cash you pull from the portfolio can be much larger than the portion that actually counts against your 0% long-term capital gains room. Furthermore, by immediately repurchasing the same investment, you reset the cost basis to today's price, so a future sale creates a smaller taxable gain. To help you visualize the composition of a sale, let's glance at a quick pie breakdown. This pie highlights that, in our example, half of the withdrawal is simply a return of principal, or basis, and the other half is taxable long-term gain. Only the gain portion applies toward the 0% LTCG bracket limit. This visual underscores why the cash you withdraw can exceed the portion that affects your tax brackets. With that distinction clear, let's compare tax gain harvesting to a more familiar idea, tax loss harvesting, to avoid mixing them up. On the left, tax gain harvesting focuses on realizing long-term gains while you're in the 0% bracket. It's typically acceptable to repurchase the same asset immediately. Wash sale restrictions target losses, not gains. This locks in a higher basis and trims future tax exposure. On the right, tax loss harvesting realizes losses to offset gains or a limited amount of ordinary income. However, wash sale rules do apply to losses, so you must avoid substantially identical repurchases within the 30-day window. Loss harvesting reduces current taxes but also lowers basis, potentially increasing future gains. In short, gain harvesting is about using a low-income year to step up basis. Loss harvesting is about cushioning high-income or gain-heavy years. Now let's turn this into a step-by-step action plan. Begin by estimating your ordinary income across wages, interest, and non-qualified dividends. Next, subtract the standard deduction to determine how much of your lower brackets are already filled. Then compute how much 0% long-term capital gains capacity remains. Identify appreciated positions that you've held for more than 1 year, and avoid short-term holdings that would be taxed at ordinary rates. Plan sales so the gain amount, rather than the withdrawal amount, fits into the remaining 0% room. Execute the sales and, when appropriate, immediately repurchase the same asset to reset basis. Carefully document trade confirmations, lot IDs, and holding periods. If large dividends or unexpected income hit, reforecast and adjust. Finally, complete harvesting before December 31st, because taxable gains are recognized in the calendar year of the trade date for taxable accounts. This table uses rounded, example figures to illustrate how thresholds interact. For a single filer with no ordinary income, the combined standard deduction and 0% LTCG bracket often allow more than $60,000 of long-term gains to be realized tax-free. Married filing jointly typically has roughly double the space. However, if you have ordinary income, such as $10,000 of interest, that income fills your lower brackets first, reducing the room available for 0% long-term gains. Always verify current IRS amounts for your filing year and reproject after dividends or other income events to avoid overshooting your 0% capacity. Next, let's map an annual rhythm so you don't miss the year-end deadline. This annual timeline starts in January and February, with organizing statements, confirming lot details, and setting targets. In March and April, as you file taxes, you update your projections for the current year. Through May to August, you monitor dividends and interest, and refine your estimate of how much 0% LTCG space you'll have. In September and October, you run a detailed forecast of ordinary income and select which long-term lots you'll harvest. Finally, in November and December, you execute the harvesting trades to fill your remaining 0% room, optionally repurchase to reset basis, and finalize documentation before the December 31st cutoff. With the process mapped, let's test your understanding with a quick quiz. Quiz time. You sell $60,000 of stock that doubled from a $30,000 basis. With no other income and the standard deduction available, how much counts toward your 0% long-term capital gains limit? Is it $60,000, $30,000, $15,000, or zero? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $30,000. Only the profit, the sale proceeds minus the cost basis, counts as a long-term capital gain. In this scenario, you can withdraw $60,000 in cash, but only $30,000 applies to the 0% limit. If you immediately repurchase, you reset your basis to the new price, reducing future taxable gains. Now let's try one more question on income ordering. Second question. Which income type fills your lower tax brackets before long-term capital gains? Your choices are qualified dividends and long-term gains, ordinary income like interest and wages, tax-exempt municipal bond interest, or Roth IRA withdrawals. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is ordinary income, like interest and wages. Ordinary income fills the standard deduction and the lower tax brackets before long-term capital gains are considered. That ordering reduces the space available for 0% long-term gains, which is why careful forecasting and timing are essential. Next, let's cover advanced tips and pitfalls to keep your strategy clean and efficient. A few advanced pointers. First, ensure you actually hold positions for more than a year so gains qualify as long-term. Track lots carefully and use your brokerage's tax lot selection to target the best candidates. Forecast interest and dividends because they consume your 0% space before long-term gains. Remember that state tax rules differ. You may still owe state taxes. Also, some benefits like ACA premium credits and the taxation of Social Security depend on modified adjusted gross income, which includes long-term capital gains, so gains can reduce credits. Keep an eye on surtaxes and Medicare income thresholds. While there's no wash sale restriction for realizing gains, those rules do apply to losses, so don't confuse them. Avoid short-term gains if you're aiming for the 0% bracket. Watch for large year-end distributions from funds that can unexpectedly add income. Finally, document all trades and reconcile them with your 1099-B to ensure accurate reporting. To cement this, let's summarize formulas you'll use repeatedly. These quick formulas keep you oriented. Taxable gain equals sale proceeds minus cost basis. The 0% room used is the lesser of your realized gains and the remaining 0% space. To approximate remaining 0% space, start with the 0% LTCG limit and any residual effect of the standard deduction after ordinary income. Then subtract amounts already filling the lower brackets. In the example, a $30,000 gain fits entirely into a remaining $32,000 of 0% space, leaving roughly $2,000 unused. Always confirm the current year's IRS thresholds because they adjust periodically. Now, let's wrap everything together and set you up to act with confidence. To summarize, exploit low-income years to harvest long-term gains in the 0% bracket. Combine your standard deduction with the 0% LTCG limit to expand your tax-free capacity. Remember, only the gain portion counts toward the limit, not the total cash from the sale. Because wash sale rules target losses, you can typically repurchase immediately when realizing gains, thereby resetting your basis and reducing future tax bills. Keep close tabs on ordinary income, dividends, and distributions throughout the year, and finish any harvesting before December 31st. Be aware of state taxes and programs that use modified adjusted gross income when determining benefits. Finally, verify thresholds each year and consult a qualified professional. To close us out, here's a quick request to help others find this video. Before you go, if this walkthrough helped clarify the 0% capital gain strategy, please like the video, share it with someone who needs a tax win, and subscribe for more practical, data-driven money content. Drop a comment describing how you plan to use tax gain harvesting this year, or ask a question about your scenario so we can help brainstorm. Thanks for watching, and I'll see you in the next one.